Right, this one's about the Scandia America case. And as I said in the main session, prior to the judgment in September, we had the FCE Bank judgment from the European Court, which had basically said you can't have a supply between head office and branch, or between branch and branch, or between branch and head office indeed. That's because it's within the same entity, so it's a single company. You cannot have a supply for VAT purposes between two branches of the same entity. It's the same taxable person, essentially, for VAT purposes. You can't supply anything to yourself. That's not quite true, because obviously you do have supplies to yourself in terms of goods moving across border, but let's not worry about that. So it didn't consider whether there was a VAT group and whether that had any implication. And in fact, in FCE Bank, there probably was a VAT group. I'm almost certain there would have been in the UK. It was a supply from head office in UK to branch in Italy. And I'm quite sure that Ford Credit is in a VAT group in the UK with Ford Motor Company. So I'm almost certain that the court found wrongly in this case, as shown by the Scandia judgment. Because if there was a VAT group in the UK, they should have said there's a supply from the VAT group in the UK to the branch of FCE Bank in Italy. But they didn't. They said no supply, no VAT in Italy. Scandia, of course, did consider the VAT group. And that was because there was a VAT group in Sweden, and it was a Swedish case. And the Swedes had taken the view that they should have reverse charge VAT on a charge from the US. So Scandia America Corporation obviously was an American company with a head office in the US, charging a Swedish branch of Scandia America Corporation, which was in a VAT group with Scandia companies in Sweden, which were exempt insurers. There were recharges within the VAT group from the Swedish branch to other VAT group members, to the exempt insurers. And the European Court obviously said, well, you know, there's no VAT on these charges, and really there should be in equity. So they tried to find some way of doing it. The case went to court because the Swedish tax authorities had registered the US head office of Scandia America Corporation and said they had to account for VAT. The judgment actually shows that's wrong. They shouldn't have done that. It was actually a reverse charge due from the VAT group and not from the head office of Scandia America Corporation. So they've assessed the wrong VAT registration. So it looks as though when it goes back to court in Sweden, if it does go back to court in Sweden, the tax authorities would lose this case. But that doesn't change the fact that the European Court has laid down these new rules for VAT groups, and they will have to be implemented by all of the member states. Certainly the European Commission has said the member states must implement this ruling. And I think they said must implement it widely, which means take all of the ramifications into effect. And the judgment, whilst a very odd judgment, is pretty clear as to what it means. And what it means is a VAT group is a separate taxable person for VAT purposes. Essentially, that's all you've got to remember. The ramifications of that are rather more complicated, but that's the change. A VAT group is now seen as a separate taxable person. It was always seen as a single taxable person. In other words, it included all the members. But now it's seen as separate from all its members as well. So what is a taxable person? The directive actually defines taxable person, and it says it's any person who independently carries out any economic activity. Economic activity is broadly business, as we would understand it in the UK. A person is a legal person, like a company, or an individual, can be either. But the real important word there is independently. Does a branch carry on business independently from its head office? It's a good question. It's not one that was really answered in the case. There was a comment which we might be able to use to our advantage, and we'll have a look at that in a minute, that a branch can't act independently from its head office. So maybe a branch is not a taxable person, but if that's the case, a branch in Sweden in this case, would not be able to make supplies for VAT purposes. So if you have a branch of an insurance company in a country, maybe it's not making any supplies because they're all made by the head office. That would be a very wide interpretation of Scandia, but maybe it's right. So this was the structure that Scandia implemented, and it was, I believe, done in order to save VAT. So it was a VAT avoidance technique. It's something that we've done in the UK quite frequently in the past. So frequently that actually in the UK we have an anti-avoidance rule to catch this for VAT in terms of the bought-in services. So in this example, no VAT on the €100 of bought-in services in the US, because they don't have VAT in the US. Services charged across border, €105, no VAT because it's within the same entity, head office to branch. And then services charged on €110 within the VAT group, no VAT because it's within a VAT group. That was the structure. What HMRC would say under their anti-avoidance rule is we want VAT on this recharge here within the VAT group. We're going to re-regard that and say it's still a supply for VAT purposes. It's not disregarded because of the VAT group. So we want VAT either on that value or, if you want to do it slightly less, just on the bought-in services, so the 100. That's what sections 43, 2A to 2E of the VAT Act say. And that is why HMRC are quite happy to allow this structure to continue, because they capture VAT on the bought-in services. They're quite happy, that's fair and reasonable. The business gains because it's still sheltering the VAT on any in-house services from the head office of SAC in this case. But Sweden didn't have that anti-avoidance provision, so in their case there was no VAT on any of the legs, as you can see there. And so they saw that as unacceptable avoidance and challenged it through the courts. As I say, they actually registered this entity and said that they wanted VAT on this value here, output tax charged by this VAT registration to this VAT registration. And that has been shown to be wrong. What should happen is that the VAT on the same value, same services, is due on a reverse charge basis in this registration. That's what the European court said. So, what about a UK insurance company with a VAT group here? Common structure is you have a separate service company which employs all the staff, provides all the back office services into the insurance company, and that's sheltered from VAT charge by the VAT group. So the initial salaries of all the staff employed in the service company are VAT free. The charge on in the VAT group is free of VAT as well. So if the insurance company is making only UK supplies, even though it's making exempt supplies, it doesn't have any VAT cost because it didn't incur the VAT in the first place. So that's great. If you didn't have a VAT group, then this charge here would be subject to VAT, and you've manufactured a huge VAT cost for your exempt insurance business. So VAT groups are quite important to have in insurance industry. The problem then comes with Scandia if the insurance company recharges some of those services around its branch network in Europe, because the recharge is going to be subject to reverse charge VAT here, where it comes into the country. It's a supply, as far as Scandia is concerned, from a VAT group to an insurance company. And the VAT group is a separate taxable person from the insurance company, therefore reverse charge applies. Apparently, Hungary has suggested that it will apply this ruling retrospectively. So the Hungarian VAT rate being 27%, this is going to cost a fortune if you've got a branch in Hungary. The same applies, of course, if the insurance company is lucky enough to employ its own staff, doesn't have a VAT group in the UK or wherever it's based, charges into a Hungarian branch, which is in a VAT group in Hungary. Again, that's going to be a supply from insurance company to VAT group and therefore reverse chargeable. So either way, it's going to be absolutely dire. There are other countries that have suggested they might introduce this retrospectively. HMRC in the UK have said they will only do it from a future date when they change their policy. And the Irish Revenue has followed suit on that. But Spain is considering introducing it retrospectively. Various other countries are saying different things. The Netherlands said they would introduce it with effect from the date of the judgment, which was 17th of September, but actually they've changed their minds now, I believe. Do you know more about that?
No, I was going to ask actually if any of them are actually going to go back, like make them go back.
It's possible. As I say, Hungary seems pretty certain that it's... You were nodding. Do you know anything more about Hungary?
Yeah, because I'm Hungarian.
Yeah. Do you know the latest?
It's an issue within our company because it is a really huge amount. Because in Hungary the statute of limitation is 5 years, which is actually 7 years.
Yeah.
It is incredible.
It's ridiculous. It's outrageous.
7 years. Impossible. So we have some kind of headache.
Yes, indeed. And of course you can't unravel the VAT group retrospectively. It's impossible. It was there. That's it. You might be able to do something about it for the future, but not for the past. Sorry.
Have you heard anything about Italy? Because someone told me that it was going to be implemented retrospectively as well.
Quite possible, yeah. I can imagine the Italian tax authorities doing it retrospectively. I haven't heard anything though, so I don't know for sure. I'll try and do a bit of research on this for the newsletter, which is coming out in a week or so, and put it in.
Panic, isn't it?
Yes.
And I know within my company people are like, maybe we should just do it now.
Well, I mean, do what is the question, isn't it? HMRC have said they're not going to implement it. We have to abide by their current policy. So you can't do it in the UK. They wouldn't accept it. With this sort of scenario where you've got a UK VAT group charging out to branches elsewhere, what they'll say is you can't have your input tax back if you've got this secondary situation where you're buying in services from outside the VAT group and incurring VAT. So the first diagram was where your services are from in-house resources, but the second one is where you're buying them in and incurring VAT on the costs and then recharging them. So HMRC would...
Then we also have costs that we recharge within our branches, and we have branch VAT groups within different countries.
Yeah.
So
horrible.
we've got, yeah, that's why it's panicking.
I mean, the best thing to do initially is just analyse where you've got VAT groups and why you've got VAT groups in those various jurisdictions. And then you can decide whether you can get rid of them or not.
Yeah, we're looking at the cost.
Yeah. Yeah. But as I say, in the UK, generally you have an insurance company and a service company. It's the normal structure. And getting rid of the VAT group increases your costs substantially, unless you can move all the employees, which is generally not possible for regulatory and other reasons. The other possibility is a cost-sharing group, and we'll look at that in a minute as an option. But in the UK, most insurance companies are quite international, have a lot of non-EU policyholders, and therefore the recovery rate is quite high, and the maximum recovery rate is 15% as a condition for the cost-sharing exemption. So it may not work for UK insurers, but we'll look at it in a minute. So this scenario, we've got costs being bought in from a third-party supplier, 100 plus 20 of VAT. If you ignore this bit for the moment, that 20 of VAT incurred by the insurance company would be recovered at its residual rate. So it would say, you know, how much non-EU business have we got as a proportion of the total? We'll have that much of the 20 back, that proportion. If you actually are recharging part of that cost outside, that would still be the case. You'd still use your residual recovery rate in the UK. There's a case in the European Court, Le Crédit Lyonnais, recently, which said you couldn't take into account the turnover of the branches, which was another outrageous judgment of the European Court, I have to say, but that is the situation. You have to recover VAT incurred in the UK on the basis of UK turnover only. So that's what happens today. In future, if this is a supply for VAT purposes, in the eyes of the UK, you should get further recovery of this because it would be recovered according to the proportion of your turnover which is non-EU policyholder, plus this recharge, which is also eligible for VAT recovery. So that's why I say you have to change your partial exemption method in order to get more input tax back in the future. Then, of course, you have a reverse charge in this country if they've implemented it and when they implement it. And Hungary would say that's for the last 7 years. So what you need to do is have a look at how costs are recharged around a branch network. What you are concerned with is a branch network within the EU. Obviously, charges outside the EU don't fall into this. But a branch network within the EU and whether costs are incurred and recharged, whether they be in-house costs or external costs. And you're asking two questions. Will the country of the VAT group admit that there is a supply, in other words, implement Scandia, and therefore allow input tax recovery, unless it's for some reason an exempt service? It may be an intermediary service or something like that. It's unlikely, but should get VAT recovery for a recharge to another member state, because normally these services will be taxable. And then the second question, will the branch country insist on collecting reverse charge VAT? Obviously under Scandia they will, but when are they going to implement it? That's the question. So if the answers are yes, the VAT group country has implemented Scandia and says there's a supply, you get your input tax back in the VAT group country. And if it's yes, the branch country collects reverse charge VAT, then you have to account for your VAT there. And you end up with a VAT cost in a new country, basically. If the answers are no and no, neither has implemented Scandia yet, then you still have the input tax costs in the head office. You know, you recover your residual percentage and the rest of the VAT is the cost. If it's yes and no, and this is where you've got a difference, yes, the VAT group country has implemented Scandia, no, the branch country hasn't. So maybe that's the charge from Hungary to the UK, for example. Then you haven't got any taxation at all. Hungary would say, yes, we've always recognised this principle, you can have your input tax back. And then the UK would say, there's no reverse charge because we haven't implemented Scandia yet. So you get no taxation in that situation. And then vice versa, if it's no, yes, you get double taxation because you don't get input tax recovery, but you do get a reverse charge. So the timing of the policy changes in the various member states is absolutely critical in terms of the overall cost here. Sometimes you can talk to a tax authority, and the Germans are pretty good at this. If you say you've got a reverse charge liability in Hungary because you've charged from Germany to Hungary, the German authorities may well give you input tax recovery even though they haven't implemented Scandia, but that remains to be seen. So I said this is really services we're talking about. Goods, there is already a charge on goods moving across border between member states, even though the ownership doesn't change. So supply from yourself to yourself is treated as VATable already within EU law. So this is really a change that applies only to services. And it's services, as I say, that are charged between branches of an entity in two different member states. If the service is bought in from outside the VAT group, the supplier is going to expect to charge VAT only in one country. So third-party supplier, if we go back to my diagram, this supplier may know that his services are going to be used by that head office and that branch. But he will only be able to say, well, I've supplied one service. The implementing regulations say I have to decide where I've supplied that in order to decide where I charge VAT or whether I charge VAT. If I've supplied it to the insurance company head office, then I charge UK VAT. If I've supplied it to this branch, then I get their VAT registration number in their country and I don't charge UK VAT, I put it on my EC sales list. So that arrow would then come over here. But there can only be one recipient for each service. So the UK supplier is not going to split his invoice and say, well, I've charged 20 to this branch and 30 to that branch and blah, blah, blah. He's going to say, well, most of my service is used in head office, I'm going to charge UK VAT. Or most of it's used somewhere else, and I'm going to reverse charge it there. Or put it on my EC sales list. So that is pretty critical. He needs to use the implementing regulations to decide where the recipient of his supply is. And it's usually going to be the head office. And that's the way it's done today. You know, I mean, that's an issue even today with recharges around branches. So is there a separate service being supplied by the head office to the branch when a partial recharge is made? My diagram showed a full recharge, but actually you should imagine that this service is used by the head office and by branches right around Europe. So there's lots of other branches in different countries, some of which will say you've got a reverse charge, and others will say, no, you haven't got a reverse charge, at least in the interim. There's a possibility, as I said, you could argue that there's nothing being supplied, even though the VAT group is a separate taxable person, according to the European Court. Nothing is actually supplied to the branch. And if the European Court is right in saying that the branch is not a separate taxable person from its head office, then possibly that might be accepted. And as far as Hungary is concerned, I think that's an argument that should be put forward against retrospective imposition of Scandia, particularly because the VAT cost in Hungary is particularly high. Some member states might accept this argument, and then again some might not. So you may end up again with a reverse charge in some countries and not in others. It just depends. But there is a pretty clear statement in the Scandia judgment which says the branch is dependent on the head office and cannot therefore be characterised as a taxable person within Article 9 of the directive. It says that in black and white. That's very helpful. It says that in the English version. It's possible that it might be slightly different in the Swedish version and therefore maybe not quite so clear. But it's worth an argument at least. Of course, as I say, that if there's no taxable person, if the branch cannot be a taxable person, then it can't make supplies either. So all the supplies that it makes of insurance are going to be deemed to have been made by the head office. And then you circle round and you say, well, if those supplies are made by the head office, maybe we can get better VAT recovery in the head office, or maybe it may have a detrimental effect on our residual recovery rate, because we do then have to take into account the branch turnover in our partial exemption method. All gets a bit complicated. So what have you got to do? What effects is this going to have? As I've said before, the partial exemption method is going to need to be updated, particularly in the recharging country, which is usually the head office country. Because you need to take into account the extra recovery you're going to get from recharges to these branches. So critical that you renegotiate that. If you're UK VAT group, then HMRC aren't going to accept it at the moment because they haven't implemented the Scandia judgment. So they'll say, well, this is irrelevant, take it away. When they do implement it, then you should get some input tax recovery. If you have a reverse charge in Hungary or somewhere else, you can argue with them now, I think, that you should have input tax recovery in the UK on related costs, even outside the partial exemption method, because our partial exemption legislation caters for input tax that was not catered for in the original method. So whatever you've agreed with HMRC can be overridden under certain circumstances. EC sales lists are going to have to be completed for these new supplies from head office to branch or branch to branch, whatever it is. So you're going to need to get the VAT numbers of all the branches, stick them on your quarterly EC sales list, and declare the amount of services recharged in that quarter. The cost sharing exemption is something that we ought to talk about, because if you are going to get rid of your VAT groups in order to not be caught by the Scandia America corporation case, then you may need to implement something else, and the cost sharing exemption is one way of sheltering costs from VAT. Basically what it is, you set up an entity which acts as a cost sharing group. So it will incur all the costs for various members of that cost sharing group, insurance companies generally. It will then recharge exactly the costs that it's incurred, and that recharge is exempt from VAT. So as long as it doesn't incur VAT on its costs in the first place, you've sheltered the costs of VAT. And obviously staff costs, if it employs all the staff needed for all the back office activities, those employment costs are not vatable. So it won't incur VAT on those. It won't have to recharge VAT on the recharge costs of those. And you've got round the VAT cost in another way. Obviously a VAT group is easier, but a cost sharing group is a possibility. One of the problems with cost sharing groups is that there are stringent conditions attaching to the exemption. You only get the exemption if the member is almost entirely exempt. So UK insurers tend to have a lot of insurance activities with non-EU policyholders, and that's not exempt. HMRC say that the limit is 15%, and an awful lot of UK insurers will tend to be 50% non-EU, so therefore they failed the condition straight away. Whether you can set up a separate insurance company to deal with non-EU policyholders and therefore reduce the percentage of non-EU in your main insurance company, it all gets a bit complicated, and it depends on the amount of cost that you're going to have from the implementation of Scandia, obviously, but there are ways around this. Now the other problem is, if you set up a cost sharing group, you can do it with a company, which is eligible for VAT grouping. You can do it with an EEIG, a European Economic Interest Grouping, which is also a corporate body in the UK and eligible for VAT grouping, and in Ireland and in various other countries. But if you put it in a VAT group, do you go back to having the Scandia problem? So in other words, your EEIG or cost sharing group, whatever it is, in a VAT group is making supplies to its members, but actually would HMRC or the tax authority in the relevant country say it's actually the VAT group that's making those supplies and not the EEIG, and therefore they're not eligible for the cost sharing exemption? And vice versa, if the members of the EEIG, members of the cost sharing group, are in a VAT group, it could be a charge by the EEIG to the VAT group and not to the member, and therefore not eligible for exemption. So you may have to strip away the VAT groups completely in order to make cost sharing exemption work as well. Has anybody thought about this at all? There's a lot to think about in Scandia, but I would suggest, even though we don't know what's going to happen in the various member states at the moment, you ought to be pulling all the information together, finding out where you've got VAT groups, where you've got recharges within the EU, and working out what you might be able to do about it in the various countries. Cost sharing exemption does work on a cross-border basis, so you can use it generally for branches. It depends on the country that you're charging, obviously. The conditions that apply to cost sharing exemption vary between the different member states because they're not laid down specifically in EU law. So, for example, I think Italy says that you can make up to 20% of taxable activity, taxable supplies, but you average it over the last 3 years. So, completely different rule from the 15% rule in the UK. There are other member states that say you can only do 10%. And then there's Poland that says you can't have any taxable supplies whatsoever if you're going to have the cost sharing exemption. So, it's not much use in Poland. So that's the cost sharing exemption. One of the people in the previous session suggested that an argument against Hungary or any other member state that tries to implement this retrospectively, possibly against its implementation at all per se, is that it unfairly discriminates against domestic insurers, because this is only going to be an issue for cross-border charges. So if you're a domestic insurer, you're not going to have these additional costs. So there is a possibility you could argue perhaps that the recharge is discriminatory. The VAT on the recharge, or the whole implementation of Scandia, really. Beyond that, I haven't come up with any other arguments, I'm afraid. Lee, have you got any?
Well, I mean, there's the issue with the UK grouping and the way that's structured, which, the fact that the US entity would be part of the group,
Yep.
which is, I think, the way the UK revenue are thinking about this and why they think they may be different.
Yeah. Yeah. Well, we have that specific legislation, Section 43 2A to 2E, the anti-avoidance provision, which nobody else has in Europe, apparently. And interestingly, HMRC appeared for Scandia in the European Court in this case and said, well, what you need, Swedish authorities, is a nice anti-avoidance provision like ours. But although the Advocate General thought that was a good plan, the court obviously didn't agree. And it was a total surprise to all of us, the court judgment. All of us, perhaps except the European Commission, who have been saying this since 2009, but then they were saying all sorts of other things that they got beaten on as well in terms of VAT groups since 2009. So I'm not sure that tells us anything. I mean, the other point about the implementation, I think, is in Germany, VAT grouping is mandatory. If you're in a group of companies, you're in an Organschaft, and therefore you are a VAT group. You're a corporation tax group, you're everything else. You don't apply for it like you do in the UK. It's not optional. It's mandatory. In France, they haven't even implemented VAT grouping at all, so they know nothing about VAT groups. What they'll do about implementation of this, I don't know. If the French are going to implement it, they will have to say, well, we haven't got VAT grouping, but we do recognise that other countries have VAT grouping. The VAT group in the UK, charging a French branch, is therefore making a supply, and therefore there's a reverse charge. But that's quite a leap when they haven't implemented it themselves. Any other questions or comments? Move on to questions. This is a VAT session, so we can talk about other VAT things if you like. Actually, I keep getting my timings wrong. Are we meant to be finishing at past or when? past, so we've got probably 10 minutes because I understand that clock's a bit fast. Lee, what's keeping you awake at night?
Well, your topic this morning on claims costs was quite a big issue, but
Right.
I mean, the other, well, insurance specific, I think that Western Shore, well, I'm fairly relaxed about Western Shore.
Because they're outside the chain?
Yeah.
Yeah.
Yeah, I think provided you're in the chain, I think...
Question is, yeah, that's an interesting one. How do you define being in the chain? I mean, I said in the main session, I've got a tribunal appeal in for transfer of leads from one broker to another. It seems to me that the first broker has tried to sell insurance. They're certainly acting in an intermediary capacity in relation to that potential policyholder. They failed to sell the insurance using their own panel of insurer. So what they've done is they've sold the lead on to another intermediary who will then try to use his panel of insurers. My argument is that the first broker is still acting in an intermediary capacity, so still acting between the insurer and the policyholder, but obviously HMRC disagree with that entirely. They have a 2008 tribunal case on their side, which is called LeadX, but that was very much a transfer of leads. And obviously at one end of the spectrum you've got Google, who allow you to just click through to an insurance company and get a quote, which is probably just advertising. I think we'd have to accept that's taxable. But at the other end of the spectrum, you've got these people who are collecting a lot of information about a potential policyholder and passing that on to another broker. I mean, it's very, I suppose the far end of the spectrum is an introducing and a placing broker being in the chain, isn't it? and that's the most obvious example of a chain which isn't direct. But the Bahir case proved you didn't have to have a direct relationship with both policyholder and insurer.
This
Yeah.
idea that providing there's no sort of steerage to the right or steerage to the left,
Yeah.
but it's fine. I can see why they might sort of be unhappy with what you're doing or your client is doing. But
I think mainly they picked it up because the agreement was very badly worded.
Yeah, well,
I wasn't involved at the time of the drafting of the agreement. So it's talking about transfer of leads and lost customers and all sorts of stuff like that, which is
yeah.
not helpful.
I think in Western Shore it was quite clear that there was a sort of a drop in of the baton, as you're running through,
Yeah.
It was, and Western Shore was dealing with a broker, no more, and clearly the independent brokers, didn't want Western Shore to get at all involved with its clients or have anything to do with it. So.
Interestingly, in Western Shore, HMRC initially agreed that the commissions were exempt, didn't they? And I don't know whether they've reversed that now, because the tribunal cast doubt on that.
Very much so. I don't know either. But, it was always the old view with HMRC, if it was commission, it was going to be exempt. They didn't need to look any further.
Yeah.
But I think the retail review has sort of opened their eyes to a lot of this, and they're now sort of looking far more at what's actually happening rather than how it was actually paid for.
Yeah, absolutely. Yeah, but they said the membership fees were taxable, and that's what they took to the first tier tribunal. I don't think they argued in the upper tribunal about the commissions, did they, if I remember rightly?
I don't see it in there.
No.
Certainly not.
So maybe they've just let that one lie, and they won't agree it next time. But yeah, it's an interesting case, and as I said earlier, I think it might go further because there's a lot of money involved.
I understand it is being appealed,
Right.
Which, I'm not sure whether that's helpful or not.
Yeah. Well, currently my case is stood over pending Westonshire, even though when we agreed the stand over, the judgment was out. So we shall see. It's actually worth a read, actually, if you were interested in the insurance intermediary exemption. The Western Shore Upper Tribunal judgment sets out the case law really nicely, and it's going to help me in my presentation of my case tremendously, even though they lost. Okay, any other questions before we call it a day? Well, not quite a day, because there's a main session to go back to yet. Don't run away. Any other questions? No? Good. Thank you very much for coming.